Okay, hi, I am Tiffany. This is my coworker, Elliot. I want to thank you guys for being here today. We know you guys have really busy schedules, and so we really appreciate the opportunity that we can come and share our message with you. It is super important for people to hear what we are teaching. We do have a lot covered, so I do have my notes with me. But we do have some things that we wanted to tap out.
Yeah, so we have these cards. After we go through the information that we have today, all of our services that we offer are free, not just for anyone that's interested in financial education, but also for clients that you may have. And so we have a little business card to fill out at the end. For compliance reasons, they ask us to get names of everyone that we present to, just so we know who we're sharing information with, and through that we can know if you guys have any interest in further education or any services for your clients that could benefit from the service. Well, we'll pass that out again.
Okay, so we came here for a few reasons today. Number one is financial education and literacy is super vital for our country today. The information that we are sharing today can be beneficial to you in your personal lives. However, you also work with clients on a regular basis who more often than not have a very direct need for greater financial education as well. We do have a referral agent compensation program where our company offers 50% of the revenue generated from referrals to referral agents when the agents have the proper licenses from the financial industry, and we'll go into greater detail on that in the end. But before we jump into our workshop today, I want to tell you a little bit about myself and have Elliot introduce himself. We're not total strangers to you. I am Brent's wife. He does the payroll for the company. But before we met, I was a divorced single mom trying to make my way. I had decided I wanted to sell life insurance because it was something that I could do. I could work from home, work my own hours, and still make a decent income. But then when Brent and I met and got married, I contacted my financial advisor that I've had for several years and had him come over and get Brent set up with life insurance. And that was one of the most important ways that I could. And so he started going over just basically the same stuff that we're going to go over with you today. And I loved what he was talking about and wanted to be a part of it. And so I joined the company. It has been really great. I've helped lots of families and I've been loving what I've been doing. I've been here a little over a year and I'm excited to keep learning and growing more. So I'll have Elliot introduce himself.
Thanks. Yeah, I'm super excited to be here too. The financial industry I find to be super intriguing, super fun, and also be kind of a happy accident that I'm working in because I had no interest in finance before I started working here. And I thought it was, I know, right? Yeah. Exactly. Yeah. So I felt like it was not exactly the industry I was shooting for. But my dad was in sales. My mom was a school teacher. I loved both of those careers for different reasons, but they both had drawbacks. I feel like the financial industry has kind of filled that void. So, for example, my dad in sales, he had the opportunity to make income based off of how workforce, income that allowed him more based off of how much harder he was work. Mom was super passionate about just helping people and providing education for people in need. But the drawback was that she didn't really have the opportunity to earn enough income to support her entire family, right? Full income household. The other thing about my dad's job was it had a lot of flexibility. Being in sales, he kind of ran his own schedule. But the problem with running his own schedule was whenever he was taking time off, working very. So I went to school for business marketing because I wanted to find a career that gave me some of the benefits of both those careers, but also without too many of the drawbacks, right? And I landed an interview with this company and found that it kind of checked all the boxes. But I was still nervous about the financial industry. I was like, I don't know if I'm really interested in numbers. It seems really dry and stuff like that. And I found very, very quickly that I love connecting with people and educating them on the finances. But the moment that I decided to plant my flag in the financial industry was when my mom reached out to me. She was a single mom school teacher, really struggling with debt and just making ends meet. And she asked me if I could teach her some things about her finances. So I took a trainer with me because I had only been working with the company for a couple of weeks, and I was like, so someone from my office came and sat down with her, and she told him that I think I'll be paying off debt the rest of my life because I don't make enough income to make extra payments towards that debt. And at the same time, because of that, I don't feel like I can reasonably save enough to ever own a home again. And he sat down with her, put together a strategy, and told her, you know what, that I've never sat down with someone that we couldn't help. So within a month with this strategy, she was completely debt free. And within a year, she had saved and invested enough to put a down payment on her home. She didn't just buy a home, she was able to construct a townhome. Like her dream kitchen, her dream playroom for grandkids, her dream master suite. She doesn't have like extravagant desires for a home, but she was able to construct something that she had always wanted, just because of the financial independence.
And you helped your mom do that.
Yeah. So exactly. So that was the moment where I was like, you know what, I could do this as a career. If I can help people like her, I can help anyone. Single parents, school teachers, anyone. It's not about how much you make. So I'm really passionate about the stuff that we're going to go over today. Our message is just so needed for so many people, and as Tiffany will go over some stats that kind of go over why people. I'm just happy to be here.
Did you help your dad?
No, my dad was like, I don't really want to do business. I was like, fair, that's great. Yeah, because I asked him, I was like, hey, do you have stuff planned for retirement? Do you have investments? Like all this stuff. I was learning about a ton, so I wanted to talk to him about it. And he was like, that's interesting, but like I have a guy and I don't really like dabble in having one of my kids know about my finances. And I was like, okay, like to each their own, but yeah, unfortunate, right? But at the same time, it's his life. So yeah, great question though. Yeah. Cool, Tiffany, take it away.
Okay, so what we like to ask our clients is on a scale of 1 to 10, how necessary is money in our lives?
11.
10, 11. Anybody else? 10. Yeah, we say it's pretty dang necessary up there with air to breathe and food to eat.
Right.
On that same scale, how are people doing financially? Not great.
We're allergic to saving for some reason. Our parents saved for decades for furniture, air conditioning, a house, a vehicle.
Yep.
And I don't know what happened in the transition. We all just became allergic to saving and waiting.
And addicted to that.
Yeah.
Not me, I think that.
That's good. Yeah.
That is good. That's how we like to do things. So typically the people that we meet with are struggling financially. There's a Forbes article in 2018 that I really like that goes into greater detail about it. It stated that 44% of Americans don't have enough cash for a $400 emergency. 33% of Americans have 0% saved for retirement. And 56% of American adults have less than $10,000 saved for retirement. So remember, this is from 2018, and because the economy has changed the past few years, so statistics, well, they've likely gone up since. And so we feel like one of the biggest reasons is because of the lack of financial education or the lack of lack of access to the financial industry. That's where we come in. We focus on education and also have access to a lot of the products that people don't have access to otherwise, unless they have a high enough net worth or a big enough lump sum. So our mission is to help people from all walks of life. We don't care if you're rich or you're poor or anything in between. In fact, we sit down with people who make $30,000 a year and struggle with money, and we sit down with people that make $500,000 a year and struggle with money. Without proper education and strategies to implement, people maintain their same habits no matter their income. We want to shift that paradigm so people feel confident to know what to do with their money. A lot of people who are even doing really well find value in a free second opinion from a professional just to see if they can be doing even better with what they have. So there are three things that we do for our clients. First is we build and implement a personal financial strategy. Every person's finances are unique, just like their own fingerprints. And so each financial strategy will be personalized for each person or family. People tend to spend more time planning for their next vacation than they do for their financial future. Next, yeah. You can't hear me?
Yeah, like right there.
Sorry, I have a quiet voice. Next, we navigate people through the 7 money milestones, which we'll go over here in just a minute. And third, we make continual course corrections as needed, also known as financial reviews. Just like how the financial strategy is fit for each person, people's life change, like getting married, buying a house, having a baby. And so we'd like to go back and go over and review their finances just to make sure that the clients are continuing to benefit from everything. So one of the biggest things that I love about our company versus other financial companies is that we are called what's non-captive agency, which means we represent hundreds of companies and therefore offer thousands of products and services. That way we can find one that is best suited for our clients. That also means that we don't charge for our services at all. The companies that we represent compensate us for bringing them clients. That way our clients can relax and not have to worry about trying to compensate us themselves. And because we don't charge our clients directly, one thing that we do charge is for referrals.
Do you have cards?
We do have cards, yes, and we can get those passed out. Brent put my cards right back there, so you're more than welcome to grab some right afterwards. So we just ask that you don't keep us a secret, because free fits in everyone's budget. Clients generally have an easier time finding a handful of people who could benefit from the free services and education that we offer. So now let's jump into the specific services that we offer our clients, starting with the 7 money milestones. We believe that steps 1 through 5 is how you become financially secure, and steps 6 through 7 is how you become financially independent. Step 1 is financial education. So our CEO is really passionate about financial education. So he does a seminar every Tuesday night about how the wealthy use their money, and he goes into detail with the wealth formula. We like to invite our clients to these seminars because it teaches a lot and helps them learn the specific things that they need to help with their own finances. The average person that works with a financial professional averages about 3% higher returns on investments than someone who invests on their own or doesn't use a financial advisor. So the best investment that you will ever make is the investment in your own financial education. Step 2 is cash flow. We like to look at the cash flow to see what's coming in, what's going out, and what's slipping through the cracks. That way we can manage the leaks they may have in their monthly budget. Sometimes people just need to make more cash flow, and so we look into options that can help them increase their monthly discretionary income. Step 3 is proper protection, which has to do with life insurance. The main form of insurance that we focus on is life insurance because it is the least understood form of insurance and most important, because death does not wait for you to become financially independent. So we want people to become educated so that they can be properly protected when, not if, death comes knocking. Step 4 is the emergency fund. It's not a matter of if you'll need an emergency fund, but a matter of when. Most clients I sit down with, if they even have an emergency fund, typically have it in their bank savings earning. Does anybody know how much they earn in your bank savings account? It's about 0.05%, or sometimes lower, depending on
average, yeah.
on average.
0.001, I wouldn't.
Yeah, just depending on what bank or credit union. And so we like to refer to that as losing money savings. We don't have to worry about the markets in bank savings, but inflation is eating alive. So we like to help clients find another alternative to saving for an emergency fund. Step 5 is debt management. Debt is the 4-letter financial swear word that people find is so easy to get into and so hard to get out of. So we say Independence Day is not July 4th. It's the last day you make your final debt payment, and then you're free. The average American, yeah. The average American has a variety of debts while making the minimum payments, which means it'll only take them 1,000 years to pay off their debt. So there are numerous strategies we like to implement to help people get out of debt years sooner, while also building habits to stay out of debt moving forward. So now that we've gone through steps 1 through 5 and now that we've built a foundation with steps 1 through 5, let's get into the fun stuff and do steps 6 and 7. And I'm going to have Elliot cover that part.
Awesome. Thanks, Tiffany. Can everyone on Zoom hear me okay? I talk pretty loud, but will you just let me know if I need to stand closer?
I would just say to go to stand step forward.
Cool. I'm a big pointer, so I'll just use the computer arrow to point so you guys can see. You can see from just these first 5 steps how the average American can benefit a lot from what we do without even looking into planning for future, right? And so most people could use help with debt, emergency funds, proper insurance protection, even outside of life insurance. There's a lot of ins and outs that people are uneducated about in the forms of protecting themselves and their families. And so this foundation is not to be overlooked. It's something that I'm super passionate about, especially after working with someone like my mom, as most people need that. However, one of the biggest differences between the people that are wealthy and the people that never are able to become wealthy or find financial freedom or independence is lack of knowledge in these 2 areas, building and protecting wealth. We want to know what vehicle, depending on someone's goals, situations, risk tolerance, a number of variables, what's going to be the right vehicle for the job to get them to their destination. And once we're there, how are we going to preserve what they've built? I don't need to inform you that taxes can be a huge disadvantage to people that don't understand how they work. And at the same time, if someone dies early, like just as we need life insurance protection, it's also very important to have wills and trusts put in place so that your beneficiaries can actually receive their inheritance rather than having it picked apart for years in probate before they see any of it, right? And so we want to help people learn how to build and how to protect once they get there. So our CEO in that seminar that Tiffany mentioned, he goes through all 5 steps of what we call the wealth formula, which is what we go into greater detail with our clients about. So I'm just going to cover 2 of those 5 things today, which are interest and taxes. No matter what strategy or policy, the wealth formula. Yeah, great question. And so the first 2 parts of the wealth formula are interest and taxes. So no matter what type of strategy, policy you go with within the financial industry, it's going to grow in one of 3 ways. It's also going to be taxed in one of 3 ways, in essence. And so when we're looking at growth, it all depends on someone's situation and what goals they have. Most people have short-term goals, but they also have midterm and long-term goals. So there's not going to be one solution that fits every scenario and every client, right? And so when we're looking at short-term goals, we might look at fixed interest rates. Fixed interest is positive because, like Tiffany was saying, you never have to worry about losing half of what you have saved in the bank, right? Because it's fixed. It doesn't drop even though it doesn't grow very fast. Because it doesn't grow very fast, we don't like fixed accounts for long-term investments or midterm savings even. And so we don't want to utilize that for short-term. This is good for short-term. We don't want to use it for long-term. Long-term, we want to look more into investing. Most products that have investments tied to them are what we call variable interest. Variable interest has a potential impact that it's important for people to understand. Because growth, whether it be in the stock market or any type of investment, works in percentages, we want to understand how percentages affect numbers. Because the downside always impacts your money more than the upside growth because of how percentages work. So for example, the numbers are kind of small here, but this little blue graph here shows $10,000. Let's say you have $10,000 saved in an investment. Let's just say you're in the stock market, 100% stocks. And if the market drops and you lose 50%, you're now left with 5,000. So the average person, just thinking quickly, they'll say, well, if the market goes up 50% again, I'll just be back at 10,000 and be back at square one. But yeah, you're shaking your head. Why is that wrong? Exactly. Yeah. So instead of going up to $10,000, a 50% gain now puts you at $7,500. So you're only 3/4 of what you originally had, with the same growth that you had losses of the year before. So in reality, you actually need a 100% rate of return just to get back to square one. So it's important for clients to understand that potential impact in knowing when they invest. I like Warren Buffett's rules of investing. He's the most successful investor in the world today. And his number one rule is never lose money, right? And his number two rule is never forget rule number one. And so when we're helping clients with investments, we want to help them make smart investments that have forms of protection involved with them, or at least be well diversified so that they don't lose so much all at once. At the same time, however, these types of savings are the best for long-term goals. There are very, very, very few investments throughout the entire world that come close to the US stock market in forms of rate of return over a long period of time, especially over the last 150, 200 years. So for long-term goals, variable interest for investing is one of the best ways to reach your goals. However, as someone gets closer and closer to those goals, we want to reallocate some of those funds to safer methods so that as they get closer to their goal, they don't lose half of it again, right? So we want to make sure we're paying close attention to someone's time frame along the way. Then the sort of middle of the road interest is what we call index strategies. This is a little bit of a newer type of strategy in the financial industry. It was introduced in the early 2000s, kind of right after the Roth IRA was introduced. And index is basically a mixture of fixed and variable in several ways. So in this type of strategy, whatever you have saved in this account will grow when the market grows because it's credited based off of an index. And it depends on what index you pick, like the S&P 500 or Dow Jones or international indexes, but it'll follow an index and grow when the market grows. However, when the market drops, you're not actually invested. You're just getting credit for what the market is doing. And so when the market drops, you're given 100% protection in your cash value and you don't lose a dime. And so the way that they're able to provide that protection for you is through what we call caps. Caps are basically just a limit on the upside growth potential. So a pretty typical cap would be like 12%. So in this scenario, you can see the light gray line would represent the market. The dark gray line is the indexed account. If the market goes up 20%, you're going to be capped at 12 if that's your cap. So you miss out on some of that upside potential, but because of that, you have 100% protection on the downside. So it's just kind of like a hybrid of the two with its own pros and cons. And so we like using accounts like this for midterm and long-term goals, especially for clients that are completely risk averse and don't want to dabble in investing at all because they're scared of it. Indexed accounts are very good for still getting double-digit returns when they really couldn't otherwise in fixed accounts. So depending on someone's scenario, we usually utilize combinations of all three of these types of interest strategies. The next, we look at taxes. So tax now is basically what we refer to as a taxable account. These accounts are the most heavily taxed accounts, but they're also necessary because they are the types of accounts that are accessible and liquid. So we need accounts like this, like a banking account or mutual funds, when we're paying for gas and groceries and mortgages. Anything that we need liquid funds for needs to be kept in a taxable account because everything else is going to have more access restrictions to it. So even though it's the most highly taxed, it's accessible, which is why we use it. When we're looking at more midterm and long-term goals, we want to make sure that we're split between tax later and tax advantaged. Another word for tax later is tax deferred. So that's something like an IRA or a 401k or most annuities. They're what's called tax deferred. Tax advantaged would be things like Roth IRAs, IULs, BULs, even things like student 529 savings plans, things of that nature. And so they both have their advantages. Their pros and cons are just opposite of each other. So in a tax deferred account, the advantages are you don't pay taxes when you contribute to this account. So you're able to put more up front. Also, if it's a retirement account like a 401k, typically you'll have an employer match that investment. And so you get extra free money put in at the front end that's not taxable for you at this time. And so it's getting front loaded really, really well. And then every year as the interest grows, you are not liable for those taxes. They are deferred until later. And so because you're not taxed on the interest every year, it really gets a chance to compound and grow much faster. So the downside, however, is because you don't pay taxes when you're contributing to it and you don't pay taxes on the growth at first, you get the privilege of paying taxes at the end when you take it out as income, right? And so the downsides to that are that A, we can't predict tax rates in the future. None of us know. Although we do know in 2026 tax rates are going up. They've already announced that. But further than that, we can't really predict the future. However, experts talk about historical tax rates and trends of today, especially with like government spending and debt. And so, and most experts say that it's very unlikely for taxes to go down, at least in the near future, just because of the way the economy is going right now. And so it's really scary to have all of our savings in an account like this when we don't know what tax rates are going to be. The other misconception is that most people assume they're going to be in a lower tax rate come retirement than they are now because they'll have lower income. However, they will also have fewer tax deductions and more tax liability. So more often than not, when we sit down with clients that are retiring, we find that they're more than likely going to be in the same tax bracket, if not a higher one, when they retire because they don't have as many claims to tax deductions as they do now. Yeah, so it's a really rude awakening for a lot of people. And so we want to make sure that not all of our savings are in here, but we do want to capture that front end potential, right? And so what we want to supplement it with is tax advantaged accounts. These accounts are just the opposite. You pay taxes on your income before contributing to these accounts, which means you get taxes out of the way. So as long as you follow all the rules that the government puts in place, you can increase your interest every year tax-free. And then even as you use it as income, it's going to be tax-free if you follow all the rules. The downside to this is obviously paying taxes up front. But the upside is that you never have to worry about taxes again. So it doesn't matter what your tax bracket is if you're not going to pay taxes on that income, right? And so one of our goals is to help clients retire in a 0% tax bracket so they don't have to worry about tax on their income in retirement. And most people are like, that's illegal, but it's totally not. There's actually a book I love about it. It's called The Power of Zero. It's where a guy goes into all the details about different methods that people use to be able to retire in a 0% tax bracket. Because we don't teach tax evasion, that's illegal, totally unethical. However, one of the biggest differences between wealthy and unwealthy people in retirement is understanding how taxes work. And so we help people understand that by utilizing all three of these buckets for different reasons, different times of life, and with different amounts of their savings. So anyway, tons of information that I just went over there. I went through it kind of fast, like dwell on the boring stuff for too long, but does anyone have any questions about that? Anything?
What was
6 and 7 are building and protecting wealth. So building, one of the biggest things we talk about is interests, like what vehicle is going to help us build wealth. Obviously, if you have a short-term goal versus a long-term goal, that vehicle is going to be different. And so we want to make sure we find the appropriate one for a client situation. Then protecting wealth, taxes is one of the biggest ways to protect what people have built. Kind of like what I was saying before, most people get hit really hard with taxes in retirement when they're not expecting it. So yeah, great question. Any other questions about this section?
not at all?
Fabulous, great. So that's basically what we do for clients. Like Tiffany went over before, these 7 money milestones are what we cover to put together a completely unique personalized strategy for our clients. And then we touch base with them every 6 months, every year, however often they need to update that plan to make sure their strategy is on track to help them reach their goals as their life changes. I'll sit down with a lot of young families. Maybe one of them's a student, they have 1 kid, they're renting an apartment, and then when I meet with them a year or 2 later, maybe they have another kid and they're living in a home, and both of them, their situation and their finances are totally different. We don't want to keep them in the old plan. We want to update their strategy as time goes on so they stay on track. So if any of you have interest in learning more about the educational financial services that we offer to our clients, that'll be on the card at the end that we go over. But one thing that I wanted to cover before then is the referral compensation program that Tiffany was talking about. So this is just our general brochure that we go over. We can ignore the last 3 on there, but our company is the fastest growing financial company in the industry altogether by far. The biggest reason for that is because we are working with 100% of the population instead of 3, because we don't have those requirements, like Tiffany was saying, for net worth and minimum lump sums to be able to open accounts with us. And so because of that, we're growing really, really fast in the US and Canada right now. And so we're looking for really, really good people who are very professional and have a clean background to work with our company, who we can train in the financial industry. However, our company, because we're growing so fast, we're receiving a lot of revenue. And in order to keep growing, we want to build professional networking relationships with other professions. So there's a lot of professions like real estate or accountants or attorneys, people that work with a clientele that are in situations currently that they could also utilize our services in tandem with what you're helping them with. And so our company is able and willing to offer compensation through this referral agent program. And so basically all we need is, because I'm missing the word, the financial industry is one of the most highly regulated industries in the country. People need to acquire appropriate licenses for it. So those of you that have passed your real estate licenses, that's way harder, and it takes way more time to get those licenses than most of the ones in the financial industry. They're a lot easier to study for and get. And so once someone has an appropriate license in the financial industry, we are legally allowed to compensate them for sending referrals our direction. And so whenever referral agents send us referrals, we'll give them 50% of whatever revenue is generated from those clients. And so we actually have a referral agent in our office now who's a CPA full-time. So he works his own accounting services, and he's going to make probably upward a little over $50,000 this year in revenue from referrals alone, just because he sends qualified referrals to our office from time to time. So for most people, 50,000 is not a substantial income, but on top of a current full-time income, it can make a huge difference in most people's lives. So if any of you are interested in referral compensation, that's also on the card that you can indicate at the end if that's something that you would like to look into. But that's all the information we have to cover today. So we'll just open up the rest of the time that we have for questions, probably for the next 5-10 minutes. If you guys have any questions, great. In the meantime, I'll start passing around these cards and our business cards as well.
You want me to put this in the chat?
Yeah, that sounds great. I have 4 pens. No, perfect. New pen.
Hey, Tiffany,
Yeah,
I am gonna stop the recording, so don't let it scare you.
okay.